Let's Talk About It Tuesday question is, with today's real estate market, should I get a fixed mortgage rate or an adjustable? Okay, good question. And the initial knee-jerk reaction for most people would be, why would you get an adjustable rate mortgage now when we know that interest rates are going up? Well, let's back up for a second. Let's talk about the difference between a fixed rate and an adjustable rate mortgage and why anyone would go for an adjustable rate mortgage or a fixed mortgage. So fixed is exactly what it sounds like. Whatever the terms are when you get the funding, when you make the agreement, that's what it is for the term of your loan, usually 20, 30 years. Fixed, doesn't change no matter what happens. And an adjustable rate mortgage, usually it is fixed for a period of time. So oftentimes it's 5 years or 7 years. And then it adjusts based on the current interest rate. So it can go up or it can go down. And usually people who are not in as good a financial position go for an adjustable rate mortgage because, believe it or not, it's easier to qualify for an adjustable rate mortgage than it is for a fixed term. And so when we look at the last housing bubble and crisis from 2005 to 2008, a big part of the mass amount of foreclosures was because the adjustable rate mortgages kicked in, that term, that 5-year term kicked in, and the interest rates went up and people couldn't afford it. As a matter of fact, what happened was what they were paying, because the values of the properties went down, was significantly more than what the property was worth. And so people found themselves in what we call upside down properties. So one of the risks is that property value could go down while the cost of the property ends up going up. And so you have this big difference between what you're paying and what the property is worth. But you could end up in a situation where we know interest rates are high now, and we know that in the short term, because the latest inflation reports just came out and inflation is still high, that the Feds are probably going to raise the interest rates again. And so if you get an adjustable rate mortgage and you're banking on, now I say betting on, this is a better term, betting or speculating that by the time your term is up, maybe in 5 years, that the interest rates will come back down, then perhaps it's a good deal. That's a bit risky because we don't know what's going to be happening in 5 years. It is also a good idea if you don't plan to keep the property beyond that initial term. So if you say, okay, well, it adjusts in 5 years, but in 5 years I'm going to sell, then sure, it doesn't matter because you'll be able to qualify for a loan easier and you don't plan on staying with it anyway. There are usually prepayment penalties if you try to refinance or sell it before the term is up, so that you have to calculate and still say, okay, even if I refinanced out before that, is it worth it based on the prepayment penalties? So it's a tough question to answer. In general, you're in a better position if you have a fixed, if you qualify, if you have a fixed mortgage, because if interest rates come down and you're still in a good financial position, you could refinance for the lower interest rate. You don't have to worry about that, interest rate going up and you being stuck with it. So today's market is still a gamble. I think it's always a gamble using an adjustable rate mortgage. But if that's the only way you can get in, and again, you have an exit strategy in case this thing adjusts another way, because that's important. Going into it and knowing the risks, you should have an exit strategy in case that thing happens, the worst case scenario, property value starting to go down, or the interest goes up significantly, making the costs astronomical or prohibitive, then you can do it. But if you don't have a plan, you're just doing it out of desperation because that's the only way to qualify, take some time, step back, get yourself in a better financial position so that you can have options. So you have the option of getting a fixed rate mortgage. Great question. I'd love to hear your suggestions. Have you used an ARM, adjustable rate mortgage? How does it work for you? What were some advantages? What were some disasters that could have happened? I'd love to hear your story. Please like, share, and subscribe. Keep the questions coming, and I'll see you next Tuesday.